this is lecture 38 of Principles of Behavioral Economics. We are discussing mental accounting. Now, in the applications of mental accounting, we are going to discuss choice bracketing and dynamic mental accounting. First of all, let us define what choice bracketing is. The evaluation and decision making situations so far considered have essentially related to either single transactions or product bundles. We can consider this approach as essentially a cross-sectional one in terms of examining different components of a transaction at the same time period or period of time. However, it has already been seen that especially in self-control situations, evaluations can be made over different time frames. Therefore, it is now necessary to take a time series approach to evaluation and decision making. Choice bracketing refers to how people segregate or aggregate choices over time periods. So, under this, first we discuss prior outcomes and risky choice. In their prospect theory paper, Kahneman and Tversky mentioned the empirical finding that betting on long shots increased on the last race of the day when the average bettor is losing money on the day and anxious to break even. So, first of all, betting on long shots implies that when the probability of winning is very small, then on such instances betting increases when the bettor is losing money on the day. So, basically he has already made a lot of losses, quite desperate, and out of desperation he is at least anxious to break even. An interesting feature of this sunk cost effect is that it depends completely on the decision to close the betting account on a daily basis. If each race were a separate account, prior races would have no effect, and similarly, if today's betting were combined with the rest of the bettor's wealth, the prior outcome would likely be trivial. This analysis applies to other gambling decisions as well. If a series of gambles are bracketed together, then the outcome of one gamble can affect the choices made later. An investigation was conducted to understand how prior outcomes affect risky choices. So, suppose it was a few problems were given, actually 3 statements were given to the subjects. The first problem states that you have just won $30, now choose between a 50% chance to gain $9 and a 50% chance to lose $9. No further gain or loss. It was observed that 70% preferred A, that is a 50% chance to gain $9 and 50% chance to lose $9. Statement 2, you have just lost $30, now choose between a 50% chance to gain $9 and a 50% chance to lose $9, the same as the statement A above, and no further gain or loss. Now, here in this case, people 60% actually preferred no further gain or loss. The situation is different only in the sense that here you won $30 and here you have lost $30. Now, statement 3 says that you have just lost $30, now choose between a 33% chance to gain $30 and 67% chance to gain nothing, and number 2 is a sure $10. Here 60% preferred the first statement or option, that 33% chance to gain $30 and 67% chance to gain nothing. Now, problem 1, it is reproduced here, shows that a prior gain can stimulate risk seeking in the same account. So, once you win in the bet, that gives you some confidence, you are willing to take more risk. It is called the house money effect, since gamblers often refer to money they have won from the casino as house money. So, basically the amount that you have won in the casino, that you feel more comfortable with further investing, keeping your initial amount or your capital invested separate. Indeed, one often sees gamblers who have won some money early in the evening put that money into a different pocket from their own money. This way each pocket is a separate mental account. Problems 2 and 3 show that prior losses did not stimulate risk seeking unless the gamble offered a chance to break even. So, these are problem 2 and 3 reproduced here. Here it shows that people actually preferred no further gain or loss in case of statement 2 and preferred 33% chance to gain $30 and a 67% chance to gain nothing. So, risk seeking was not here, but risk seeking was here only because there was a possibility of break even, that if you win $30 then you are going to break even. In the beginning you lost $30, you can win $30 also, in that case no loss no gain, because there is a probability of break even. That is why people were risk seeking in problem 3. The stakes used in the experiments just described were fairly large in comparison to most laboratory experiments, but small compared to the wealth of the participants. Limited experimental budgets are a fact of life. Next we talk about narrow framing and myopic loss aversion. In the gambling decisions discussed before, the day of the experiment suggested a natural bracket. Often gambles or investments occur over a period of time, giving the decision maker considerable flexibility in how often to calculate gains and losses. It will come as no surprise to learn that the choice of how to bracket the gambles influences the attractiveness of the individual bets. So, basically bracketing is important in your decision making process. An illustration is provided by a famous problem first proposed by Paul Samuelson. Samuelson, it seems, was having lunch with an economist colleague and offered his colleague an attractive bet. The bet was like they would flip a coin, and if the colleague won, he would get $200. If he lost, he would have to pay only $100. So, in case you win, there is plus 200, in case you lose, there is minus 100. The colleague turned this bet down, but said that if Samuelson would be willing to play the bet 100 times, he would be game. Samuelson declined to offer this parlay, but went home and proved that this pair of choices is irrational. So, basically his friend made irrational decision, because Samuelson showed that an expected utility maximizer who will not accept a single play of a gamble for any wealth level that could obtain over a series of such bets will also not accept the series. So, if you are not making, you do not expect to make money in the first bet and you decline it, then following rationality you must decline all possible bets, the series of all the bets. There are several points of interest in this problem. First, Samuelson quotes his colleague's reasoning for rejecting the single play of the gamble. I won't bet because I would feel the $100 loss more than the $200 gain. So, see, this sounds very much like what is prescribed by the prospect theory. If the loss aversion coefficient as measured by KT is 2.25, then the loss would be valued as minus 225 while the gain is only 200. So, basically the loss pinches the more, and that is why the colleague is perfectly meaningful in declining the bet. Modern translation, that is in terms of the prospect theory, it implies that I am a loss averse. Second, why does he like the series of bets? Specifically, what mental accounting operation can he be using to make the series of bets attractive when the single play is not? Suppose Samuelson's colleagues' preferences are a piecewise linear version of the prospect theory, a value function with a loss factor of 2.25 given as, here we are writing utility of x equals to x. This is a piecewise linear version, that is basically again a linear expression for x greater than equals to 0 and 2.25 multiplied by x for x less than 0. Because the loss aversion coefficient is greater than 2, a single play of Samuelson's bet is obviously unattractive. We just explained that. We multiply x by 225, it becomes minus 225 and gain is simply 200. So, it is unattractive. What about two plays? The attractiveness of two bets depends on the mental accounting rules being used. If each play of the bet is treated as a separate event, then two plays of the gamble are twice as bad as one play, and then as Samuelson argued that if the individual is not willing to play a single bet, he or she must not be willing to play any of them. So, a series of bet should also be rejected. However, if the bets are combined into a portfolio, then the 2 bet parlay yields positive expected utility with the hypothesized utility function, and as the number of repetitions increases, the portfolio becomes even more attractive. Now, in case of there are 2 bets, so there is possibility 1 that the fellow wins both the bets. So, 2 wins. If he wins twice, then his payoff would be 400, 200 from each win. It has a probability of 0.25. There is possibility of 1 win and 1 loss. In that case, he would be getting 100 because 200 minus 100 is 100. There is possibility of 1 loss, that is, first he loses and then he gains. So, 1 win, 1 loss, 1 gain, again this is 100, and there is possibility of 2 losses and the gain is minus 200. So, there are 4 alternative situations. If we assign each situation, so each situation has a probability of 0.25. Now, since these two have the same outcome, so we can combine them to have 100 0.5 and then minus 200 0.25. So, Samuelson's colleague should accept any number of trials of this bet strictly greater than 1 as long as he does not have to watch. Now, let us work it out. We consider the PT value function for r equals to 0. Here the reference point is assumed to be 0 because this is just coming as a random gain. Alpha and beta were measured to be 0.88, lambda was estimated to be 2.25. Now, this is the prospect theory value function x raised to the power alpha for x greater than equals to 0 and minus lambda minus x raised to the power beta for x less than 0 for r equals to 0. Now, for one bet the prospect is simply 200.5 minus 100.5. The value function will be, see, we are having minus 2.25 multiplied by 100 raised to the power 0.88 multiplied by the weighting function or decision weight, which is W minus 0.5, because this is the loss, and 200 in the domain of gains 200 raised to the power 0.88 multiplied by W plus 0.5, they have the equal probabilities. Now, we calculated this to be equal to 0.45 and W plus 0.5 equals to 0.42. Just remember, we use the formula P raised to the power gamma, P raised to the power gamma plus 1 minus P raised to the power gamma whole raised to the power 1 upon gamma. For gains, it takes a value of 0.61, gamma takes a value of 0.61. For loss, it is denoted by delta and it takes a value of 0.69. So, plugging in these for values, I obtained these numbers, and multiplying I have, or from this expression I have minus 14.23. So, overall value is in negative. It is obvious that the individual will not accept the bet. For 2 bets, the prospect is this already explained. The value function now would be, we begin from the lowest value, which is minus 200. So, this is the value scale calculations multiplied by W minus 0.25. Then we have 100 raised to the power 0.88. We are using cumulative prospect theory or cumulative decision weight. So, that is why W plus 0.5 plus 0.25 minus W plus 0.25, that is subtracting this, and then finally 400 raised to the power 0.88 multiplied by W plus 0.25. This gives us a value of 2.67. This is positive. So, any bets greater than 1 should be accepted, and as we increase the number of bets, you can calculate yourself that the value actually increases. These are the values of W minus W plus calculated. More generally, loss averse people are more willing to take risks if they combine many bets together than if they consider them one at a time. Indeed, although the puzzle to Samuelson was why his colleague was willing to accept the series of bets, the real puzzle is why he was unwilling to play one. Risk aversion cannot be a satisfactory explanation if his colleague has any significant wealth. To explain the fact that many people do reject attractive small bets such as Samuelson's colleagues, we need a combination of loss aversion and one bet at a time mental accounting. There is a mental accounting explanation for what economists call the equity premium puzzle. Equity premium is basically the difference in the rate of return on equities or stocks and a safe investment such as treasury bill. So, since stocks are riskier, you basically ask for a premium that is a higher return. So, this is known as equity premium. The puzzle is that the difference in the rate of return on these two assets has historically been very large. Taylor noted that in the USA, a dollar invested in stocks on January 1st, 1926 was worth more than $1,800 on 1st January 1998, whereas the dollar invested in treasury bills was worth only about $15. So, this has increased from 1 to 1800. So, an 1800 times increase, while the other has increased only by 15 times, and half of which was eaten up by inflation. So, if you consider inflationary factor, then this $15 would actually appear even bigger or smaller. Though a part of this difference can be explained by risk, but the level of risk aversion necessary to explain such a large difference in returns is implausible. So, if you go by the loss aversion factors, then you would find that no, a loss aversion coefficient or risk aversion coefficient would be too large to explain the difference between these two. One way to examine is to consider how frequently the investors should evaluate their investment to make themselves indifferent between the two investments. If investors have prospect theory preferences, simulation suggested a period of 13 months. You evaluate it after a period of 13 months, you would be indifferent between the two investments, either stocks or bonds. This outcome implies that if the most prominent evaluation period for investors is once a year, the equity premium puzzle is solved. That is, if the investors are evaluating more frequently, less than 13 months, then they would of course find the bonds safer, more attractive, and they would invest in bonds and would not invest in stocks. Alternatively, if investors have a narrow frame of evaluation of once a year or more frequently, less than a year, the equity premium puzzle could be explained. This is termed as myopic loss aversion. The disparaging term myopic seems appropriate because the frequent evaluations prevent the investor from adopting a strategy that would be preferred over an appropriately long time horizon. So, when we are not able to see things at a distance far off, then we suffer from myopia. So, myopic is again here applied because when we are not able to see the long term potential of investments in stocks, we may end up choosing bonds which probably may appear attractive in the shorter horizon, but then in the long term stocks are much more value generating or yielding. Indeed, experimental evidence supports the view that when a long term horizon is imposed externally, subjects elect more risk. For example, in an experiment, subjects made investment decisions between stocks and bonds at frequencies that simulated either 8 times a year, once a year, or once every 5 years. The subjects in the two long term conditions invested roughly 2/3 of their funds in stocks, while those in the frequent evaluation condition invested 59% of their assets in bonds. So, when you are frequently evaluating, you are investing in safer assets which produce lower returns, but if your evaluation periods are longer, then you might end up investing in stocks which give you higher returns. Similarly, in another experiment, the staff members at a university were asked how they would invest their retirement money if they had to choose between two investment funds A and B, one of which was based on stock returns, the other on bonds. So, A and B, two alternatives, one is based on stocks, the other is on bonds. Stocks are riskier, bonds are safer. One group examined a chart showing the distribution of 1-year rates of return, and the other group was shown the simulated distribution of 30-year rates of return. So, one is showing short term rates, seeing short term rates, another is seeing the long term rates. Those who saw the 1-year returns, that is short term rates, say they would invest a majority of their funds in bonds, that is in safer assets, whereas those shown the 30-year returns invested 90% of their funds in stocks. So, when you look at the long term returns generated, then you understand that stocks are preferred over bonds. Myopic loss aversion is an example of a more general phenomenon that Kahneman and Lovallo called narrow framing. Projects are evaluated one at a time rather than as part of an overall portfolio. This tendency can lead to an extreme unwillingness to take risks. Narrow bracketing can also have other perverse side effects. For example, in New York, as in many cities, the cab drivers typically rent their cars for a 12-hour period for a fixed fee. They are then entitled to keep all the revenues they earn during that half day. Since 12 hours is a long time to drive a car, especially in New York City, the drivers must decide each day how long to drive, that is, whether to keep the car for the full 12 hours or quit earlier. This decision is complicated by the fact that there is more demand for their services on some days than others, specifically on days where there are certain disruptions. Maybe it could be weather related disruptions, it is raining, then people would need taxi services more as compared to situations when it is a normal day. A rational analysis would lead drivers to work longer hours on busy days, as the policy would be maximizing earnings per hour worked. So, on the day there is greater demand, you can have more rides and earn more money. At the same time, your hourly rates could also be higher. Overall, there would be an increase in income. So, rational analysis say that a rational individual would always look for higher and higher income working for the same 12 hours. If you can earn more money, then why not? So, you must work more on the days there are certain disruptions or the days which are busy days. If instead drivers establish a target earnings level per day, they will tend to quit earlier on good days. So, basically if the drivers think that every day I must say make $3,000 done, they would quit. The elasticity of hours worked with respect to the daily wage as measured by the earnings of other drivers that day is strongly negative. So, as the hours worked increases, the daily wage, basically there is a negative relationship, daily wage decreases or daily wage increases, alternatively I would say the hours worked decreases. The implication is that taxi drivers do their mental accounting one day at a time. They are not thinking about their long term, how much money to build up, save, etc. Another thing is the diversification heuristic. The unit of analysis can also influence how much variety consumers elect. In an experiment, children were asked to select among 6 snacks like candy bars, chips, etc. In one of the two conditions, sequential choice, they picked one of the 6 snacks at each of 3 class meetings held a week apart. Simultaneous choice, on the first class meeting, they selected 3 snacks to be consumed 1 snack per week over the 3 class meetings. So, in one situation, they are asked to choose sequentially. When you are going for a meeting, you are choosing one snack, and in the first other case, simultaneous choice, in the first class meeting you have to tell what are the snacks you need in the upcoming meetings as well as today's meeting. It was observed that in the simultaneous choice condition, subjects displayed much more variety seeking than in the sequential choice condition. For example, in the simultaneous choice condition, 64% of the subjects chose 3 different snacks, whereas in the sequential condition only 9% of the subjects made this choice. So, in the case of sequential condition, suppose a child comes for a meeting, she or he has one particular snack as the most favorite one. So, it is highly possible that every time she comes for the meeting, she would pick up the same snack. This is happening, a week apart. While if a child is asked to pick up 3 things, then chances are very high that she would pick up 3 different things. So, this is called diversification heuristic. This behavior might be explained by a variety seeking serving as a choice heuristic. Alternatively, people tend to diversify when asked to make several choices simultaneously. A failure to account for this kind of behavior may lead to incorrect predictions. Reid and Lowenstein called this diversification bias and observed similar patterns in their experiments when candies picked up by kids on Halloween night. So, in that experiment, the subjects in the experiment were young trick or treaters who approached 2 adjacent houses. For example, in one condition, the children were offered a choice between 2 candies at each house. So, you have to choose one between two candies offered. In the other condition, they were told at the first house they reached to choose whichever two candy bars you like. Large piles of both candies were displayed to assure that the children would not think it rude to take two of the same. So, basically they can pick up any two. The result showed that a strong diversification bias in the simultaneous choice condition, every child selected one of each candy. In contrast, only 40% or 8% of the children in the sequential choice condition picked different candies. So, in the first condition, when they would be asked to pick one candy out of two, then in each and every house probably the children were picking up the same candy, while when they were asked to pick up any two candies, then most of them basically selected different candies. This result is striking, since in either case the candies are dumped into a bag and consumed later. So, it is the portfolio in the bag that matters, not the portfolio selected at each house. Benetzi and Thaler have found evidence of the same phenomenon by studying how people allocate their retirement funds across various investment vehicles. There also diversification bias is observed. In particular, they found some evidence for an extreme version of this bias that called the 1 by n heuristic, where if an employee is offered n funds to choose from, then she evenly divides the money among the funds offered. So, if suppose I have given 4 alternatives to invest my money and I have 10,000 to invest, it has been observed that I would be equally dividing 10,000 into the 4 funds, that is investing 2,500 in each one of them. So, this is called 1 by n heuristic. This heuristic can be utilized to increase exposure to any particular type of funds. Now, this can be actually useful also. How? Use of this heuristic or others only slightly more sophisticated implies that the asset allocation an investor chooses will depend strongly on the array of funds offered in the retirement plan. Thus, in a plan that offered one stock fund and one bond funds, the average allocation would be 50% stocks and 50% bonds. But if another stock fund were added, then again they will be equally dividing it, like 33% in one fund, 33% in the second one, 33% in the third one. One of this is bond, the two others are stock. So, if there is a tendency to equally divide the money into all funds, then you can understand that the allocation to stocks would jump to 2/3. They also observe that employees seem to put stock in the company they work for into a separate mental account. So, stocks of other companies and stock of the company they are working for are again different accounts. For companies that do not offer their own stock as one of the options in the pension plan, the employees invest 49% of their money in bonds and 51% in stocks. So, roughly 50% divisions are there. When the company stock is included in the plan, this investment attracts 42% of the funds. So, when the company stocks are offered, people invest 42% of their money in the company stock. If the employees wanted to attain 50% equity exposure, then like generally what the tendency is to go for a 51% investment in stock or 50% exposure to stock. So, in that case they have already invested 42%. So, they should have actually invested 8% of their money in stocks, the leftover, and the rest should be in bonds, like again 49 to 50% in bonds. Instead, it is observed that they invest their non-company stock funds again evenly. So, 29% in stocks and 29% in bonds. So, once they have invested 42% in their company's stock, then they are left with 58%. Now, you consider the other funds that are available. One is a stock and other one is a bond fund. So, then you are dividing 58% equally between the two and then allocating 29% and 29% to each. This also results in higher exposure to the stocks. These are in the market, these are the company stocks. So, with this I conclude the discussion on choice bracketing, where we primarily have discussed narrow framing or myopic loss aversion. We have also discussed diversification bias. We will continue with our discussions on mental accounting, primarily working on policy implications of mental accounting in the next module. Thank you.